Hello, everyone. Thank you for joining us. We're excited to have you and honored to have you for our 6th annual Voorhees Economic Development Incentives Conference. In just a few years, this has become the largest annual economic development incentives conference in the country. We really appreciate all you who have attended in the past, and for you who haven't attended in the past, we welcome you. We hope this is going to be a great week of informative presentations. I help lead the incentives team here at Voorhees, and I'm pleased to have you. A couple preliminary things before we jump into this presentation. Please fill out the surveys. This is free CLE, CPE, CE. It's all we ask because we use the surveys to help guide future presentations. Next, obviously ask questions. Be aware that we do sometimes have media attend these, but of course you'll be in front of 200 plus of your favorite friends on this presentation, so I'm sure you would choose your words carefully anyhow if you do have something to discuss. And then finally, stay tuned. We're going to be presenting part 2 of our Ohio Transformational Mixed-Use Development Seminar, tax credit seminar. This one was heavily attended. That's been a very popular program. We hope you'll join us for that, so keep your eyes out for your emails. I have nothing further, so I'm going to hand it over to Aaron to kick off this.
Welcome. This is Bonds 101. All right. Can you hear me okay?
Yes.
Let's try again.
We can hear you, Aaron. Technical difficulty. Aaron will be dialing in, but Gene or Dan, do one of you want to get us started while Aaron? There he is. Okay.
Am I not working? Oh, great.
Aaron, you're working. Can you hear us?
I can hear you now, yes.
You're good.
All right. So
Okay.
Technological snafus. Give me a thumbs up if somebody can hear me. All right. So this is, I'm joined by Gene Carter Ryan. Gene joined the Finance Authority in January of 2007 as his first employee. Prior to joining the Franklin County Finance Authority, Gene served as Deputy Director of the Economic Development Division within the Ohio Department of Development for over 11 years. Under Gene's leadership, the Finance Authority has partnered with economic developers, government entities, and financial institutions to provide creative funding options for projects in the private, nonprofit, and public sectors. The Finance Authority has provided more than $2.7 billion in financing and has earned an A- bond fund rating from Standard & Poor's Rating Services for its Central Ohio Bond Fund. Also joined by Dan Blank. Dan is a managing director in the Ohio offices of D.A. Davidson & Company and was previously a managing director at Ross & Clair and RBC Capital Markets. Dan has over 39 years of experience as an investment banker and financial advisor to virtually every type of tax-exempt and taxable issuer, including state agencies, counties, cities, and economic development, both private and public. He specializes in structuring economic development transactions that utilize tax increment financing, special assessments, and private placements. So with that, we'll go ahead and get started on Bonds 101. No project too big, no question too small. So for all the parents out there who now have the Paw Patrol theme song going through your head, you're very welcome. So to understand where we are with bonds and what bonds are, you have to go back in time and back in history a little bit to the railroad bond story. The practice of bonds and how things developed really get their root in the 19th century railroad expansion. And in Ohio, the idea was if you could get the railroad to come to your small town, to your hamlet, to your city, boom times would sure to follow. And so the play was to convince every municipality to issue bonds and to try and acquire right-of-way that could then be used to entice the railroads to come. And the idea being that the bonds were issued at a time where the tax base couldn't support the payments, but that was okay because the railroads would come, tax values would skyrocket, and there'd be plenty of money. So the bonds were issued. Right-of-way was purchased with the proceeds of those bonds, and of course, calamity ensues because the railroads may have come, they may have not come, but the economic boom times didn't exactly follow. And when it came time to pay for the bonds, there just wasn't enough tax revenues available. And the bondholders came expecting payment, and the idea that they have a bond. The municipality promised to pay them. They gave them their full faith and credit. Well, the municipalities fought back, went to court, and said, well, that might have been true, but there's all kinds of Ohio statutory law that govern how bonds should be issued and how debt can be borrowed by political subdivisions, and we didn't follow those. And you bondholders aren't entitled to payment. So even though they took the money, even though they used the money, they didn't have to pay it back. They won in court, which was great. Municipalities were very happy. They didn't have to pay. The problem was, a couple years later, the municipality probably needed to borrow again for its next public infrastructure. And this time, the bondholders weren't so forthcoming. And instead of taking the word that the political subdivision was going to pay them back, they made somebody stand up and give a legal opinion and issue a promise that the municipality, that the governmental agency had followed all of its required statutory authorities. And that was the origin of the bond practice. Was what happened is eventually they hired law firms to go ahead and issue a legal opinion that says they did everything that was required, the municipality did, and you, the bondholder, are entitled to payment. You have a valid, legally authorized bond issuance, and you can expect to be paid. So let's move on through here. The key players in a bond transaction. The first is bond counsel. They are the party who gives the legal opinion, who makes sure that the political subdivision has borrowed in accordance with all applicable law. That legal opinion is issued to the bondholders and can be relied upon. The bond counsel will also opine as to whether the interest on the bonds is taxable or tax exempt for federal income tax purposes. We also have the issuer. That is always going to be a political subdivision. Can be a county, can be a city, can be the state, can be a port authority or a finance authority, as Gene Carter Ryan is. You also have underwriters or placement agents. These are the financial institutions. These are the expertized and regulated individuals that will help find buyers for your bonds, will help structure the transaction, and serve as a conduit between the issuer and the eventual bond purchaser. Those can vary. It can be large institutionals, it can be single buyers, it can be friends and family, it can be wealthy institutional investors or retail investors. The underwriter is going to help evaluate what your bond, what your structure looks like, and who the potential buyers are going to be. Underwriter will also have its own counsel involved, underwriter's counsel, and there may be special counsel called disclosure counsel who's hired to help put together a disclosure document. You also may have rating agencies. These are S&P, Moody's, and Fitch. These are the entities that go out and put a rating on an issue of a bond issue. It helps determine who the potential buyers may be. A lot of pension funds, a lot of large institutional buyers are limited to the types of buy, and the ratings help drive the audience. So without a rating, if it's an unrated security, you're going to be limited to a specific type of investors. If you go ahead and are able to get a rating, depending upon what that rating is, will open up or close doors to who the buyers are. There also may be a municipal advisor. This is a fairly new regulated role. They have to be an independent registered municipal advisor. They're registered with the under the SEC and the MSRB. And these are advisors that owe fiduciary duties to the individuals that they're going to be advising. So the underwriter serves as sort of a broker, an arm's length transaction negotiating between the issuer and the buyers. The municipal advisor is going to be the person who the issuer can rely on for advice. There also will likely be a trustee. bond register or paying agent. These are often large financial institutions. The transaction after closing. So they will be the party who will collect the revenue stream and direct that the payments get made out to the bondholders. In the event of a default, they're going to be the one exercising remedies and appearing to collect and try and generate dollars from DTCs, the Depository Trust Company. On issues that are DTC eligible, there's usually a single bond that's issued to a nominee of DTC, and then there are participants throughout the system that just have interest, book entry interest in the bond. So there's only really a single bond, and DTC's presence helps and allows the bonds to be easily tradable and a more fluid market to exist. Finally, there may be some credit enhancers. The market has changed quite a bit since I've started practice 20-some years ago. Originally, almost all bonds that were issued had some form of credit enhancer. It was either a bond insurance or a letter of credit issued by a financial institution, and this created sort of an even stream so that all bonds really looked the same. Because it didn't matter if it was a hospital in Columbus or a hospital or a school district in Toledo. If it was insured by a large insurer, it really traded and acted the same. The first financial crisis greatly weakened the credit positions of the credit enhancers, and now they are much less prevalent, though you still see them from time to time. So those are the key players in a bond transaction. But really, what is a bond? It's just a special kind of debt instrument. Bondholders have a right to the identified assets, sometimes referred to as the trust estate, or an indenture of trust, and that is the legal vehicle by which the stream is pledged in order to have a first priority interest in that asset. So if there is a default, if there is a situation where you've run into financial difficulties, the bondholders are able to look to the value of the trust estate and be first in line. Really four primary types of bonds. There's the general obligation. That's the full faith and credit. That's when your city or your county goes out and gives all of its taxing authority, all of its revenue sources behind it. If it's a voted levy, like a school district, it has the ability to continue to raise taxes necessary to generate sufficient funds to pay the debt service. It's the gold standard of bonds, and full faith and credit obligations are very, very strong, especially here in Ohio. The next category down are special obligation or revenue. These are not general obligation. These instead will identify a specific type of revenue that the bondholders are going to be looking to. So it could be a water and sewer system, or it could be a specific revenue source. Generally, though, still belonging to the municipality or the political subdivision. There also can be special types of special assessments. This is a particular type of tax to address a project to be built. It's a little bit like a special obligation or revenue, but it has a slightly different characteristic. And the final type is the conduit security. That's what you'll see most often in economic development. And the key fact about a conduit security is it's not our money. And by not our money, we're really referring to the issuer. The issuer is a political subdivision. It could be a county, or most often in Ohio, it's a port authority, which the Columbus-Franklin County Finance Authority is. Although they are the issuer of the debt is totally supported by obligations from the borrower. And so if it's loaned to a company, if it's loaned to a hospital, it is only the hospital revenues, or only the revenues of the private company, that are used to support the bonds, not the general dollars available at the Port Authority. These are not tax-supported obligations. Bondholders have no right to have taxes levied, and you will see that statement placed prominently on every conduit security bond, that they are not full faith and credit obligations, and bondholders have no right to have taxes levied. So we talked a little bit about the bondholder story and the railroad story from the 19th century. And as a result, there were a lot of restrictions placed in the Constitution to prevent political subdivisions from getting themselves into trouble. One of those is found in Article 8, Section 6, which prohibits lending of aid and credit. It requires by the Constitution that no laws shall be passed authorizing any political subdivision, whether it's county, city, town, or township, or unvoted, to in any way become a stockholder in any joint stock company or to loan its credit to or in aid of any such company, corporation, or association. This is known as the prohibition, which causes a bit of a question, because if we can't lend aid and credit in Economic Incentives Conference, most people on the phone are here because they're interested in trying to find credit for their projects. Over time, the state of Ohio has adopted numerous exceptions to the general prohibitions against lending aid and credit. For our purposes, the most common one is the economic development exception, which used to have language up on top here of the slide. It seems to have disappeared. That provides that if you're going to create jobs, if you have economic development, you can provide support, you can aid and lend your credit, provided that the monies raised by taxation shall not be obligated or pledged for the payment of bonds or other obligations issued or guarantees made. And that caveat is very important. You'll see that in a lot of settings where a county or a political subdivision is asked to provide support to your economic guarantee, other than those raised by taxes. And those revenue sources could be fees, could be licenses, could be other dollars that are generated, are able to be pledged for economic development projects. So there's the section. One thing to keep in mind is that bonds are securities. Generally, they're what we call municipal bonds, and they're exempt from federal registration requirements. So if you're familiar with stocks, they have to be registered through an initial public offering, and there's a whole set and series of regulations that have to be gone through, disclosure that has to be required. None of those by law are issued by political subdivisions. There are a few federal laws that still apply in these contexts. Most commonly, you'll see 10b-5, which is also known as the anti-fraud provisions. Restrictions on the statements you do make need to be truthful. You can't omit to make a statement that would make the statements in your disclosure document misleading, and that you have potentially criminal or civil remedies if you violate that rule. There's also indirect regulation of the market, commonly known as Rule 15C-212. That requires continuing disclosure. So if you're going to the market and you're selling your bonds into the public market, you will be required to have at least annual updates on the information that you told to the market when you sold the bonds. If you're going through a bond fund, which I know Jean will touch base on a little bit more in her presentation, the bond fund itself is the one that will provide the continuing disclosure. Finally, you have tax-exempt versus taxable bonds. If bonds can be issued tax-exempt, there's an effective subsidiary from the federal government. Significant rules and limitations apply. In order for it to be a tax-exempt debt, you have to either not private security. By private business use, what they're looking for is a business, a trader business having a special legal right to the asset that's being financed. So you think about a parking garage. If a parking garage can be utilized by a private entity and has a right to have more than 10% of the spaces, that's going to fail the private business test. If it's just available to the general public it's okay to rent spaces to individuals. So I could purchase a spot in the parking garage without being considered private business, as long as I'm not, because of who I work for, having a special right to my parking spot. Private security is, and payment is looking to the source of the revenues and repayment. General taxes are not considered private payment, but if there's a special promise with respect to your tax payment, like a minimum service payment where you're guaranteeing that if the taxes aren't sufficient, that's violation of the private security. You can have one or the other, but not both. And finally, there can't be a private loan. So these are the questions that you'll go over with your underwriter and with bond counsel as you're trying to structure the transaction if you're trying to issue tax-exempt debt. So with that, I'm going to turn it over to Jean, who is frozen on my screen. So hopefully I haven't just been talking into the ether.
Hi, Aaron.
Go ahead, Jean.
I actually can hear you loud. Okay, so yeah, I'm ready to jump in. Hello, everybody. Really appreciate the opportunity to present here today. As Aaron has mentioned, I think really laid out the great groundwork for who we are and what we do. Just thought this little infographic could give you a sense, fast facts about us. We were established in 2006. Over that time frame, we've issued $2.7 billion in bonds and for some low interest loans. Last year, we issued debt on 23 different transactions, $290 million. So the pandemic didn't impact us too greatly. We've done that with a staff of 4. So you can see we're a small organization, but because of the team, and when I mean team, it's the financial advisors, our legal counsel, working together, we've been able to accomplish quite a bit and have a real impact, I think, in Central Ohio. So, issuer's perspective. What do we do? Our programs are, we issue bonds, both conduit and our bond fund. Aaron went over both of those 2 areas, and we'll go into some detail from my perspective on those. We also make loans. We have our own energy efficiency program that we securitize through the Property Assessed Clean Energy Program, which allows for special assessments to be placed on buildings that in turn you collect your revenues to pay off the debt through that mechanism. We also have a new program, Small Business and Neighborhood Impact Program, where we make loans from the Finance Authority's capital directly to small business and nonprofits in our neighborhoods. It's a new program that we've rolled out. And we've just closed on our first loan that went to a really active nonprofit, Community Development for All People, which is active here in Central Ohio, located on the Parsons Avenue corridor just south of Children's Hospital. We also have the ability to provide a capital lease for projects. This is one of those that we have available to us that allows us to really provide some significant benefit for projects that qualify. Our National Association says Ohio's Port Authority programs are some of the most flexible financing statutes in the country. Other state programs don't allow for this type of program through their financing entities. And in this case, we work with projects that are building buildings, and then we can take, we basically enter a capital lease with that building, with that developer, and the construction materials are not subject to state and local sales tax, which for some of the really large projects that we work with, that can be a significant benefit. So from our perspective, we want to ensure that because we are one of the only non-elected bodies that can grant a tax exemption, that we work very carefully to ensure that the projects that we do are aligned, in our case, with Franklin County's economic development objectives and strategies. So we don't do every project that comes in the door. We don't do market-based, retail types of projects. We don't do a lot of multifamily projects. We do office and distribution centers and projects where there's some kind of competitive nature. So that's another area that we get actively engaged with in Franklin County. And again, for those of you statewide, all of your ports will have their own view on how they administer those programs. Most can issue bonds. Most do not have bond fund programs. Most do not have loan programs, but all can also get involved in the capital lease structure if it's something that they're willing to do. So let's talk a little bit about conduit bonds. As Aaron mentioned, this is really based on the borrower's credit. We don't have any credit risk associated with the transactions that are conduit financing. Many are placed with the bank. And those terms then are negotiated between the borrower and the lender. The reason that they come through an organization like ours is that in order to finance something tax exempt, you have to have an issuer. And again, issuers can be, like Aaron mentioned, other local governments. But in fact, most don't want to get into this space. They've got enough going on managing their own debt. So they can come to port authorities to issue that debt on behalf of the project. One of our most prolific clients through this particular program is OCLC, which is based in Dublin. We've been working with them extensively. We just closed on our 7th issuance with them. So they work closely then again with the local bank. In the last 2 deals that they've done, it's been with Key Equipment Finance. So this is something that, again, organizations like ours can do to help get someone like an OCLC, a 501c3 nonprofit, which has the ability to borrow at a tax-exempt rate, those lower rates available to them through, in this case, Key Equipment Finance. We've also been seeing in this conduit financing space more activity with private placements. So this is potentially where we will work with developers who want to purchase their own debt, that they see that they believe in their project, they've got personal funds that they want to invest and see a decent rate of return on that investment. So for our examples, it would be where we've got local tax increment financing deals that we've placed developers. We've closed on one with some local developers. It's called the San Margarita TIF, which for those of you local, it's on the west side of Columbus. The developers were able to they basically purchased those bonds investment portfolios. The rates on those bonds are dictated by the reimbursement agreements with the cities. So cities have the ability to cap those rates. And so we have to ensure that we're aligned, that those rates don't go any higher than what's allowed within the reimbursement agreement. Another project that we did that with is, again, in the short north, the Hubbard parking garage, which has been very active. They had there were 3 sets of bonds when we issued that project, publicly placed bonds and then privately placed different tranches of debt through B and C bonds. Some were taxable bonds, some were tax exempt because there were some restricted uses. So we issued these different tranches of debt depending upon the use. Placement types of conduit bonds. Aaron also mentioned we have our own Central Ohio Bond Fund. It's rated A- by Standard & Poor's. And this is not based on the project's credit profile. It's based all of the other financing authorities, port authorities that have bond funds, and that's Toledo, Cleveland, Akron, and the Southwest Ohio Bond Fund, which is both a Dayton, Cincinnati combined bond fund. We have all raised money that we put basically in our reserves so that we can go to the national capital markets and sell that debt. Again, that A- rating allows that debt to get a more attractive interest. So what entities like ours do, we're always looking to increase our reserves as we issue more and more debt. We're right now in the process of increasing a letter of credit that we've got with the Huntington from $10 to $15 million, and we have $5 million in cash on top of that. So that's our money. So if there's a default, the first place that we go for transactions. I will also tell you that those of us with bond fund programs have almost all made commitments that before we hit the reserves tied up in the indenture, we're going to make that payment on our own outside of the indenture so those reserves aren't hit, because the capital markets don't really want to see your reserves touched. So that's, again, our credit risk associated with these bond fund programs that drive them is that they're long-term fixed rate financing. So for example, TIF bonds will go as long as the TIF. So we can go out to 30 years, which lenders can't do. We fix that rate at the time that we close on the financing. So it's very clear what your debt service is going to be, both taxable or tax-exempt deals. And again, taxable when it does not qualify for tax-exempt financing. And as Aaron also mentioned, and I mentioned with the Hubbard parking garage, when we're doing a deal where there's some reserve spaces set aside that don't meet the terms set for public parking, we can issue a taxable tranche of debt. We also issue taxable bonds for our property assessed clean energy program bonds. For the bond fund, again, we work with underwriters who place that bond with investors in the capital market. So we rely really heavily on them to understand what bond buyers are interested in our debt, who is going to give us the most attractive rates for our clients. Close working relationship with underwriters, because that's key for us in order to really manage the program as efficiently and effectively as we can. What we have seen in our portfolio is we do a lot of infrastructure. That seems to be our sweet spot. So public infrastructure that's being funded potentially through TIF bonds, tax increment financing. What we've seen in Central Ohio in particular is there has been a lot of activity through new community authorities where potentially the property is exempt through a CRA or enterprise zone, and we're still looking to fund necessary public infrastructure. We've created a significant number of new community authorities where the parcels pay for the debt related to the public infrastructure. So that's what we've seen a significant amount of here in Central Ohio. We do, when we're looking at our underwriting, so what kind of projects do we want to do? We focus on the borrower credit. We don't look at project, job retention, or creation, which is what your local communities and the state government are focused on. That's not what we're focused on. We want to just ensure that we're going to get paid back. We do want to see community impact. We're looking, is the developer, is the market, is their strength? We look at financials. We go through a traditional, very deep due diligence and credit underwriting. We want to see what kind of experience the client has in the space that they're involved in. For us, again, security is critical. I'd mentioned, we are involved with tax increment financing, bond issuances, new community authority, bond issuances, and minimum service payments. These are the ways that we basically structure a credit that we take to the markets. And I'm just going to do a little sidebar here. One of the things we really like about new community authorities is that when you're able to put one in place, part of the issue that we had noted when we were issuing TIF bonds is that we always needed to have some coverage. And what I mean by that is that we couldn't issue bonds based on a one-to-one. We're going to get $100 of TIF revenue, so we could issue $100 worth of TIF bonds. We had to ensure that if the TIF dollars came in less, that there was some kind of, there was some sure that we were going to get paid. So we were looking at 115 or 120 coverage. With NCAs, you can set the NCA charge on an annual basis, so you're able to really use the full extent of that TIF. You don't lose any dollars. You can set every year what that debt service calculation needs to be, or what that NCA charge needs to be. So it's a really for those of you who haven't worked with them, I'd suggest you give some serious consideration and look into that. We found that to be a very effective tool on our behalf. Oops, sorry, I think I went too far. So what sort of, I always like the lessons learned. What have you done that you think, oh God, this went drastically wrong? And we actually had a situation last year. We've never had a default. We've never had a late payment. Things have gone remarkably well for our organization. But last year we had one of our clients paid their property tax bill late. They paid it before we actually had our bond payment due, but they payment date for the Franklin County Treasurer. And what that means is that when the Franklin County Treasurer settles, they have a specific date where they then pass the funds on through the auditor's office over to the local municipalities and then on to our bond trustee who actually pays bondholders. if you miss that date, there's no way to get a hold of those funds. So this was a TIF based on one very large user, and this payment came in late. So we were not able, we didn't have funds available to us to make that bondholder payment. We used some of our own funds outside of the reserves that I mentioned. We had set aside $1 million that if in fact a case like this ever came up, we were going to be able to make sure our bondholders were paid on time. And we did. We used $100,000 to make a one-time payment to those bondholders, so they were paid on time. But Standard & Poor's was very concerned, especially in the height of the pandemic, and they put us on negative watch due to procedural concerns. So again, Franklin County's got their date. It was missed. And so we really had to revisit how we structure some of our bonds. So it's only happened that time, but our remedy is that we are now looking to structure our bonds where the first half payment for TIFs or New Community Authority charges would not make the payment for our May 15th due date. We will in fact use that to pay our November 15th bondholders. The bondholders are paid twice a year, May 15th and November 15th. Allows us to ensure that we will always have appropriate amount of funds so that bondholders can get paid. Fortunately, the changes that we've made, we've gone back to Standard & Poor's and they took us out of that negative watch and we're now stable again. But for us, you know, it's not an end of, it was very concerning for an organization like ours. So again, I think it's one of those things you're always looking to, and this is one of those issues that we faced last year that kind of was a nice lesson learned about doing something a little bit differently. Candidly, if you're a developer, that's not really what you want to see because it adds some cost to the bond, but it's something that we're frankly being forced to deal with because of what happened in this case and the fact that if we ever get another deal like this, that they could downgrade our bond fund, and we can't have that. So that, I think, my part of the presentation. And again, as Aaron said, we'll be happy to answer questions as people see fit.
Absolutely. Thank you very much, Jean. Dan, you want to take over and talk a little bit about bonds from the underwriter's perspective?
I do, Aaron. That would be great. Good afternoon, everybody. Pleasure to be in front of everybody. As Aaron introduced me earlier, my name is Dan Blank. I'm a managing director with D.A. Davidson. I put a couple slides at the beginning just to introduce everybody to D.A. Davidson if you aren't aware of who we are. I work out of the Mason, Ohio office, and D.A. Davidson is a national firm, roughly 1,400 employees, 96 offices in 27 states. And D.A. Davidson specializes in municipal finance and is also an investment banking firm. One of the specialties inside of the municipal finance is the structured finance or economic development teams, and that is what I specialize in. And my coverage area has historically been the Ohio region, but we work with most all the port authorities throughout the state and with a lot of the municipalities as well. We are headquartered in Montana, and our fixed income group is headquartered in Denver. We have 175 professionals in our fixed income group. But one of the things I wanted to point out on this slide, which I think is important, is our average daily trades in bonds is about $100 million. And I think that becomes very important when you're looking at an underwriter or a placement agent. What that means is that we are in the market literally every single day in the primary and secondary markets, talking to investors, showing them new transactions, understanding what they will or won't buy or what limitations they would have. So I think that is very helpful as we try and approach the marketing of the bonds. These are just some of the areas throughout the country that we're in. And as I mentioned, my coverage is the Ohio, Kentucky, Indiana area, but certainly can venture beyond that. From an underwriting perspective, these are our 4 last years of production. We are the number 4 underwriter in the country as to volume of issues. with 517 issues in 2020. Aaron alluded earlier to an underwriter versus a financial advisor, and I just want to start out the presentation with just kind of a distinction between the two. Our regulatory body, FINRA, defines an underwriter as such and a municipal advisor as such, and there are distinctions between the two. But for better or worse, there is some crossover in what their roles are. So an underwriter, as Aaron described, ultimately will sell the bonds on behalf of an issuer and is the person who's going to get to the market and deliver project proceeds. We do, however, still do financial modeling and underwriting as part of that process in order to understand the cash flows, understand the security that might be available, and then try and determine where and what the best purchaser or market would be. From an underwriter's perspective, the underwriter is going to be involved either very early in the process or certainly late in the process to market bonds. Municipal advisors are typically working with issuers and help with structure and timing as well. The distinction between the two is the underwriter sells the debt and a municipal advisor does not sell debt. And from FINRA's perspective, you're kind of one or the other. Again, a little bleed over, but you have to pick a role from my perspective early on. As we look at the marketing options that are out there, there's probably three large buckets, which is public offering, private placement, or a direct purchase. So in a public offering, not always the case, but usually the case, it may be a less complex transaction. We do offer it to a general market, so it's a wider targeted market. Structure is, and as Gene mentioned, in the bond fund, you are marketing the bond fund's credit and not necessarily the underlying credit of the transaction. So for that reason, we will get to a specific marketing day, price in one day, and then settle typically 1 week later based on the criteria of either the rated transaction or the market itself. What will contrast that is a private placement. Typically, we have seen those as more complex transactions, and they have a much longer runway when you're trying to sell into that market, because what you're doing is you're going out to a limited number of investors, typically institutional investors that are very sophisticated, and you are going to structure that transaction specific to that buyer and that buyer specific to your transaction. So we are really negotiating all aspects of the transaction with the buyer. That buyer, we do require an investor letter to show they're sophisticated. And there are two ways to sell into that market. One is through a private placement memorandum, which is very similar to an offering document in a public offering. It's going to be a very long document, probably 50 to hundreds of pages, and will include kind of soup to nuts on what the project is and what the credit is. Conversely, we have sold projects just on investor term sheets. So it might be a 3 to 10 page term sheet which describes the transaction, but there's not really a full direct offering document. Either way works. The term sheets in clear terms of timing sometimes are a little faster, but again, either one will work and can be suited to any transaction. As Gene and Aaron mentioned with the direct purchase, we have seen direct purchases historically over time, and we've seen them kind of come back in recent times. So effectively, that would be a direct purchase either by a developer or sponsor, or a friends and family type of purchase where there may be a group of investors. That is a senior debt purchase or it can be a subordinated bond purchase. The differences when you go with direct purchases is oftentimes you will not structure it such that it would meet the ability to be sold in the primary or secondary markets. And what I mean by that is, as the direct purchaser, you'll have flexibility to determine what the coverage ratios need to be, if you need a debt service reserve fund, these kinds of things. And oftentimes we'll see direct purchasers say, I don't necessarily need those because I'm going to purchase and hold this. So if that's the case, that works fine. If you think that there is a point in time where you may want to sell this into the secondary market, it may need to be refinanced at that time, again, because it didn't have the criteria to meet what would be marketable in those markets from the inception. Advantages and disadvantages, there are some in each of these markets. In the public offerings, oftentimes these are rated transactions, but they can also be non-rated transactions. The documentation is, I hate to say this whenever there's attorneys, but it's a little more canned, only because it's a little less structured, and it may be it will be replicated from prior transactions. So that can make the overall process a little more expeditious. Interest rates, as I mentioned earlier, are fixed at the time of marketing. So unless the market implodes, you've got a pretty good sense of what your rates should be, and you're negotiating them with buyers. But again, you're not negotiating necessarily terms with buyers. On the private placement side, and I'm going to assume a non-rated transaction at this point, the rates are competitive. You are going to a buyer group that is a sophisticated buyer group, and the rates, while competitive, may not always be as competitive as a rated public offering, and probably I can assure you they won't be. But there are other considerations when you're looking at those. And when we look at these transactions, we will look at both a rated and a non-rated, public versus private, and kind of show you what the pros and cons of each are. So in a private placement, some of the negotiated items, which you, again, will negotiate directly with buyers, would be shorter call features, maybe more aggressive coverage ratios, smaller debt service reserve funds or debt service reserve funds, which are funded over time, either in whole or in part. And then you could have also covenants such as release of guarantees, additional bonds tests. That all becomes negotiated, and that will all impact the overall structure and obviously the effective interest rate at the end of the day. When we look at the bond documents, again, each are tailored very specifically to the transaction and may or may not meet any general requirement that has ever been happened before. So we have some transactions, which I'll allude to later, which we collectively created to fit a need, and it made a lot of sense for those. In the private placements, the cost of issuance typically are a little more expensive because, again, you are nuancing your transaction to specific buyer's terms, and it's from a legal perspective, you're writing it kind of on the fly, and from a placement, we're doing the same thing by negotiating that. As I mentioned with direct placements, senior or subordinated debt, the terms that you can control would be the coverage requirements, debt service requirements, maybe capitalized interest requirements where you can have a long interest rate as opposed to getting paid immediately out of the gate. And we see that on a senior basis, it doesn't necessarily generate new cash to the project. It may be equity you were going to put in anyway. On a subordinated basis, it may be equity that you've already put in, and we can evidence with a subordinated debt. So you'll not only get the return of the equity, the ability to sell and capitalize your NOI, but you'll also get a return on your bonds as well. So it kind of juices that return just a bit. Gene mentioned earlier taxable and tax-exempt, and Aaron did as well. The good news with taxable and tax-exempt is that we've seen both the private and the public markets accept that. Typically, taxable versus tax-exempt is going to be driven by the private or public purpose of the bond issue. Maybe all or some of your bonds won't qualify tax-exempt, so we've seen that bifurcated between the two. The low interest rate environment right now has compressed those spreads. So we historically have seen 200 to 300 basis points, and right now it's 50 to 100 basis points. So the good news of that is that you don't have to have kind of the tail wagging the dog and be overly concerned that a taxable component is going to drag the overall financing down because of the interest rate spread. They're very compressed right now, and we do see a lot of tax-exempt and taxable on a blended basis. Historically, we have seen the private placements probably in the last 5 to 7 years become maybe a more desired path, if that is an option. We've got buyers out there who are sophisticated. We lost a lot of buyers back in 2008, but the buyers that have remained are very sophisticated and understand the markets very well. So that's been a positive. The buyers tend to be large institutional buyers, and usually, depending on the size of the transaction, it's going to be just one buyer or maybe two buyers. We've seen buyers all the way up to $50 million on a single buyer. So I think a lot of these funds are yield hungry right now. And when you can see interest rates, we see them, again, it just depends on the asset class and what the project is, but we see them from 4% up to 5.5%. And if you compare that to, a rated transaction from a buyer's perspective, it's quite different. So I think that there is a very good market right now. And then obviously the objective of all these, whether it's taxable or tax-exempt, is to get the most project funds to the project. And therefore, we evaluate the covenants and the requirements from both the buyer's perspective and the issuer/borrower perspective. When we look at complex transactions, and I'm going to look at this more in the TIF increment financing vein, what we do is we will approach these financings, as I mentioned earlier. We're going to evaluate the project based on the specific assets or asset classes. We'll look at projected market values for each asset, and ultimately there will be a third-party administrator that will come in and do the projected market values, and we'll work within those confines that they come up with, and those are going to be based on comparables. They're going to be based on NOIs. They're going to be based on Marshall and Swift analysis. So there's a lot of different things they'll do to project those values for us. We'll look at the timing and completion of each asset, which will dictate when the cash flows will be collected for the first time. We'll create the financing model based on all those criteria, and then look to see what we're trying to target for the project fund. And those models are fairly exhaustive. They're going to be cash flow models for debt service interest rates, sensitivities to the types of markets we're going to get to, private versus public, rated versus non-rated. We'll also look at school compensation agreements, and then we'll look at the cash flows after debt service to see if there is an availability to either create a subordinated debtor if it's needed, or if the cash flows are going to need to go back to the school as additional compensation or back to the municipality. So we will evaluate all those pros and cons. As an example of the ability to kind of negotiate with investors on these types of projects, we closed a project last year that was a multi-use project, and it had 5 distinct asset classes and 5 distinct cash flows. So it had 2 office buildings, retail, hotel, and parking revenues. So when we looked at that in aggregate, we were talking to investors, and we were getting a specific coverage ratio that they were going to require and a specific set of interest rates. And that was not getting us to the projected project fund that we were trying to target. So we went back to them, and we were able to bifurcate each of those assets and cash flows. So we took the office. The first office was a triple net lease to a credit tenant. The second one was a spec office. The third was retail. The fourth was a hotel to be built. And the fifth was the cash flow from the garages. What we did was we separated each of those with a different interest rate and a different coverage factor. And then when we reblended them all together, that lowered both the interest rate and the coverage factor, and we were able to derive the net project funds that we were targeting. So I'm not saying that's a model for everybody's transaction, but those are the kinds of things that we work through trying to evaluate and get to a position where we can get to market and, again, try and satisfy the needs of the project. One of the questions we get is what size transaction makes sense? And this will vary. I would say that when you're looking at the port issuers, that their targets are probably $7 million and less, although they can go higher because they can coordinate with other ports and get higher. When we look at private placements, probably about a $3 million project is not necessarily an absolute cutoff, but it's where we've seen some of the buyers start to cut off, and it's really more a function of what the buyers will purchase as opposed to whether or not it may make economic sense. We closed an issue last year that was about $2.5 million, and it netted about $1.7 to the project fund, which was the exact amount that they did need to complete some public improvements. So in that instance, while it was smaller, it did make economic sense. Clearly, fixed fees such as legal fees and other professional fees are going to have a greater impact on smaller projects as a percentage. But again, when we look at tax increment as an example, it makes sense to take real estate taxes, turn them into payment in lieu of taxes, and to fund a piece of a project as opposed to maybe just using that to pay taxes. So I think that does make economic sense to do that. The other question we get is, when do we get involved? And this always sounds self-serving, and it probably will again. I like to say as early as possible. From an underwriter's perspective, we can evaluate the project, look at the project, know and understand what markets are available. The other aspect of projects is, I think everyone knows, we closed a project last year that we started in 2013. So for better or worse, sometimes these take much longer than we all anticipate. And again, we are there for the duration as needed. Aaron?
All right, thank you, Dan. We have some great questions in the Q&A, so keep them coming in. And if you have questions, we will do our best to get to them. If we don't, we will answer them and follow up afterwards. But we've got a couple questions with respect to the overlay and the overlap between a CRA and a TIF. Can you layer the two together? And then why would you want to do that? And so I'll start off and then throw it to Dan. But yes, absolutely, these things can work in connection and in conjunction together. And a lot of times you are in a situation where the CRA is already in place. It was a broad-based CRA that automatically covers the area, so you have lost the ability to do a TIF for a period of time that would generate revenues to pay for your debt. And then you can overlay an NCA on top of that. You've got a CRA that will abate it. You've got a TIF that turns the payments into bondable pilots, NCA on top of it as a third layer in order to generate some revenue stream to pay bonds in those early years. And Dan are nodding their heads. Dan, you want to talk a little bit about that sort of interplay between the three and what you're trying to achieve?
Absolutely. So we are currently working on 4 different issues that will have a combination of CRA and TIF. And 2 of those projects, they are apartment projects. So there's a 15-year abatement, and in both cases, I think it's 100% abatement. So what we're doing in those instances is during the first 15 years during the CRA, we are going to create a special assessment and carve back some of that CRA. And the dollar amount that's carved back is really a decision of the developer. How much do they actually need to get people to rent their properties, and as opposed to how much they actually need in public improvements to support the inception of the property. So what we're doing in one of the instances, we're carving back about 20% of the CRA, which will fund effectively interest expense for the first 15 years. And then when the CRA expires in year 16, we start collecting TIF. So we back-end loaded the debt. And that's really going to be consistent with both of those transactions. A third transaction is where we have the same situation, but the CRA already existed and we don't have an ability to carve back anything from the CRA. So we are going to pick up the back end under the TIF in year 16, and some other assets will support the early years. And as Aaron mentioned, you can also layer on an NCA on top of that to be your collection mechanism during the period of the CRA.
Yeah, and the nice thing about an NCA is it creates tax-like payments that can be structured and give the same benefit of a tax lien. Because what you have with the TIF when you have pilots is you're a bit ahead of your traditional commercial mortgage. And the advantage is that they're not accelerable, so all the debt doesn't come due at once, so the commercial mortgages are comfortable with them. But the stream, because it's tax-like, is ahead of them. I think we've got time for one last question, and it was, what's the difference between tax-exempt and taxable debt, and can you, is there a story from history that might help us understand the difference? So it is from the history way back to pre-1986, which is further and further in the rearview mirror for everybody. But pre-1986, before the Reagan tax code amendments, you could really finance anything on a tax-exempt basis. If it was in the purview of the Port Authority to finance it, it was going to be deemed to be tax-exempt. In 1986, they viewed that as too much of a giveaway from the federal Treasury, that too many dollars were being foregone by not collecting interest on these bonds. And they created a whole bunch of tests. And if I could sum it up in 30 seconds, you look at who owns it. Is it a governmental entity or a private entity? Who uses it? Is it a governmental entity or a private entity? And who pays for it? If it's going to be governmental on most of those issues from a structuring basis, or at least available to the general public, then you can possibly qualify it as tax exempt. Otherwise, it's likely to be taxable. So if you're talking about airports, there are special types of categories that can be privately owned. Those are exempt facilities, but for most of what our economic development we're talking about, if it's an office building, it's going to be taxable. If it's a garage, it could be tax exempt depending upon how you structure it. If it's public infrastructure, roads, sewers, and others, and it's truly infrastructure, it's not somebody's private driveway, that's going to be able to be structured as tax exempt. So with that, I think we have reached our hour limit. So Gene and Dan, thank you very much. Hopefully the technology was smooth for everybody, and everybody was able to see and hear. Thank everybody, and hopefully you'll sign up and participate in our additional seminars throughout the week. So thank you very much.
Thank you, everybody.
Bye-bye.